Welcome to This Week in South Carolina. I'm Gavin Jackson. As the number of COVID-19 cases continue to rise, as do the deaths, Governor Henry McMaster this week issued a stay-at-home order, mandating that all South Carolinians only stay at home unless they need to go out for essential services or for work. Lawmakers, however, did return to Columbia this week in an attempt to pass an emergency funding measure that failed. Also, South Carolinians continue to help each other out in their time of need. This is the latest from the week. Average daily coronavirus infection rates doubled last week to 187 per day from the week before, and while this week average daily cases were trending around 160 per day, death rates also continued to increase. The numbers prompted Governor Henry McMaster to formalize his previous pleas for folks to stay home and only visit essential businesses by issuing a full-scale stay-at-home order.
It is now time to make these recommended actions required. Why is it time? Because too many people, from the statistics, from the facts, from observations, too many people are on the roads, too many people are on the waters, too many people are in the stores, too many people are not requiring with our requests concerning social distancing.
Officials are also preparing for a surge of cases and have identified areas where an additional 3,000 hospital beds can be deployed by early May, when our peak is expected. This would include previously shuttered hospitals, arenas, and field hospitals adjacent to current facilities.
I've seen a lot of work across South Carolina hospitals over the past 4 weeks, and I am confident that we will be ready. On behalf of MUSC, we know this is going to be tough. This is not going to be easy. We have a hospital that normally has about 800 patients in it. We are ready to surge that hospital approximately another 150 beds. To go beyond that into the second level facility, we are going to use our fitness center, which is about a block away from the hospital, to surge another 250 beds, if needed.
In the State House on Wednesday, more than 130 lawmakers, some wearing masks and gloves, others just in suits and dresses, gavelled in a legislative session for the first time in weeks to pass a continuing resolution to keep state government funded, since a budget will not be passed before the new fiscal year on July 1st.
And so that's why we're doing what we're doing here today with the continuing resolution that sets the dollars on this current fiscal year as we move forward. Let me say this, we will be back, and we will come and we will fulfill our constitutional duty to produce a budget to the citizens of South Carolina. But we're going to do that when we know what our economy looks like.
However, a flare-up between the House and Senate over the handling of Santee Cooper during this time led to both houses passing two different funding measures. However, House lawmakers did their business within an hour and did not pass a sine die resolution or a continuing resolution from the Senate, which either means House lawmakers will begrudgingly have to return to pass those measures, or the governor will have to order them back after May 14th. Record high unemployment numbers were released this week as more South Carolinians become food insecure, especially seniors. In light of this, places like Columbia have set up emergency feeding sites specifically for seniors now for the third week in a row.
In addition to serving 600 seniors on Meals on Wheels every week, we're also now serving 2,000 additional seniors around Richland County. A lot of our seniors we're serving now wouldn't typically be on a Meals on Wheels service. They wouldn't typically be looking out for food assistance and find themselves in a food insecure situation, but they are, because they have limited income. They can't order takeout. They feel unsafe going to the grocery store because of pre-existing health limitations, of which South Carolina is in the top quarter percentile in the country for that. And so it's really meeting a huge need in this area, and there's sister agencies all around the state doing similar work.
Stay safe and healthy.
And now with us to discuss the economy and COVID-19 is Jovan Nessen. He's a research economist at the USC's Dartmouth School of Business. Joey, thanks for joining us.
Thank you, Gavin. Great to be with you.
And just before we get into the latest unemployment numbers and economic data, I want to ask you quickly about your experience with COVID-19. It's good to see that you're doing well. Give us a little insight about what happened there.
Sure. Well, about 3 weeks ago, I co-led a trip to Germany to study the automotive cluster there during the student spring break. And my colleague and I both contracted COVID while we were there. And I was sick for a few days when I got back with moderate flu-like symptoms. But fortunately for me, the symptoms overall were fairly mild. I was able to get over it quickly and get back to my more normal routine. So I was very fortunate, but yes, it was a very unusual couple of weeks, to be sure.
Gotcha. Very good to hear that you recovered from that. Speaking during that time, weeks ago, we were going to talk, but since then we've seen some record-breaking unemployment numbers. I want to talk about those. We just got the new ones out this morning. 16.6 million Americans, or about 10% of the U.S. labor force, is out of work. When we look at South Carolina, we again smashed records with 85,000 South Carolinians filing for unemployment last week. And we saw that overall be like 181,000 South Carolinians applying for these benefits. What's your reaction to these numbers now we've seen, successive weeks of just climbing gains here?
Well, I think we have to put this in perspective because this is a very different contraction period than what we normally see in a more normal economic contraction or recession. And it's more akin to a natural disaster like a hurricane, because to put it in perspective for South Carolina, during the Great Recession, we peaked out at about 10,000 unemployment insurance claims per week, but that lasted for well over a year, so a very long intensity. And by contrast, so far, we've seen an average of about 60,000 unemployment insurance claims per week since the governor initiated his emergency declaration. So that's far more intense than we're used to seeing, but there are many reasons to think why the time frame will be much shorter. So more intense, but the time duration will be likely shorter. So just a very different phenomenon from the normal economic contractions that we're used to seeing.
Mm-hmm. But when you look at the long-term ramifications, obviously you're talking short-term, what can we maybe extrapolate from this and maybe deduce? I mean, because obviously unemployment numbers, they're a big metric when you look at measuring the overall economic health of a place like South Carolina.
Well, the second quarter this year is certainly not looking good. And in South Carolina, we see industries across the board affected. Of course, leisure and hospitality, tourism, the hardest hit, the accommodations and food services. Manufacturing is being hit as well. And also medical services. The medical industry is being affected too in the top 5 major industries that is impacted by unemployment. And we typically don't think about that because, of course, the emergency services are seeing high demand. But if you look at all non-essential medical services, things like physical therapists or dentists, they're actually struggling a bit too. So a broad swath of the South Carolina economy is certainly being affected. And there are basically 2 realistic paths to economic recovery that we are anticipating. Sort of the more optimistic scenario is if the pandemic begins to abate before the summer begins, before Memorial Day. And the less optimistic scenario is if it extends into the summer, where we would see more bankruptcies among small businesses that are having to hold out. And that would potentially move the recovery from the second half of 2020 to early 2021. So broadly speaking, those are really the bookends or the range in terms of what we're thinking based on what we know now in terms of what the economic recovery will look like.
With those scenarios, Joey, when we do talk about potential and future recovery, you're talking about businesses. I'm wondering, when we look at those unemployment numbers, and would they spring back in a sense? I mean, I know we're talking about, a lot of businesses are talking about furloughs, keeping employees on in some degree, but also able to claim unemployment. So should we be able to bounce back easier? I'm guessing, will that be, whatever the recovery looks like, will still be somewhat better than the recovery we saw play out over years after 2008?
Most likely, yes. It depends on how long it takes for the pandemic to abate and for the social distancing guidelines to be relaxed. But the silver lining with these unemployment data is that a large majority, about 80%, are looked to be temporary in nature. That is, they are being reported as temporary layoffs as opposed to permanent job losses, which suggests that once the pandemic abates, that we will see a rapid recovery and rapid rehiring. But again, that depends on the length of time, because as we move into the summer months, if we don't see the social distancing relaxed, a lot of these smaller businesses can't really hold out. They don't have the financial or the capital resources to do so. So we may see a series of bankruptcies that would create a new round of layoffs and a new round of ripple effects that could extend this further. So it really depends on how long the social distancing is required to be maintained.
And when we talk about those kind of ramifications and what could be a new normal, do you think we're also going to maybe start seeing people who were in really hard hit affected industries start shifting into new industries? I'm thinking, obviously everyone, even manufacturers now are really grinding to a halt. We'll talk about Boeing and BMW in a moment, but I'm wondering, do people start shifting from maybe hospitality and food and beverage to maybe something that they might, start getting training for something else, for a different industry that is going to bounce back maybe quicker?
Well, I think that we are already seeing a high demand in all delivery-based services and the logistics industry. Certainly Amazon, for example, is hiring now and seeing very, very strong demand. And I think that general trend is going to continue long past this current pandemic. We're going to see a sizable shift in multiple industries. And I think the big two, of course, logistics and delivery services, that's going to continue to grow and expand. But also if we look at other sectors such as commercial real estate, where people are now more likely to potentially work from home going forward, we may see some structural changes there as well. So a number of industries will be affected. And of course, brick and mortar stores, which have been largely in decline in recent years. This just exacerbates that trend. And so, yes, I think there will be a lot of shifts coming based on how we're seeing new demand and how these industries are being affected differently.
Gotcha. A lot to look into, especially as a research economist. You'll be, studying this well after this all kind of recedes. But I want to talk about the Fed. We just saw them unveil a $2.3 trillion stimulus plan, essentially a lending plan for small, mid-sized businesses, U.S. cities and states. This helped the markets kind of absorb the rough news about more unemployment numbers today on Thursday. I'm just wondering what we're seeing, and do you think that everyone's kind of pouring as much into this as possible, from Congress to the Fed to even at the state level we're seeing some actions being taken?
Yes, I think so. And it's certainly not going to eliminate the negative economic activity that we are seeing, but it will help. It will help mitigate some of it. And of course, one of the things that they are trying to do is to preserve consumer spending. That's what the stimulus checks are all about. And also to preserve payroll dollars and preserve employment. So the more that they can keep small businesses going, the less we are likely to see additional layoff activity. And the more that these businesses can basically wait out this social distancing requirements and hopefully mitigate some of the damage and minimize some of the losses and help us get on a faster path to recovery whenever that happens to be, in the second half of 2020 or into 2021. So I think it helps. It's necessary, but certainly it's not going to eliminate these losses, but it will help some.
And when we look at our economy, we were also talking about tourism, hospitality, obviously the big brunt of these unemployment numbers up front. But now we're seeing more and more ripple effects with our manufacturing industries. Boeing, BMW, name a few. BMW extending their suspension of their plant in Spartanburg. Boeing announcing that they're going to be suspending operations in North Charleston indefinitely for the time being. That affects about 7,000 employees. I'm just wondering what are we starting to see now as we kind of, we're more than a month into this situation in South Carolina. What are we going to start seeing now, in your opinion, with these other big industries in South Carolina?
Well, I think in terms of manufacturing, there are 2 points to make. The first is that, yes, manufacturing is being significantly affected. They're among the top 5 sectors that are affected already by the layoff numbers that we're seeing, by the unemployment numbers that we're seeing. And also, that is extended through temporary staffing. So many of the temporary staffing firms that place workers, they place them into manufacturing firms. And temporary staffing is also an industrial sector that is among the top 5 in South Carolina, looking at high levels of layoff activity. So manufacturing disproportionately affected, that's definitely true. But on the positive side, manufacturing is a traded cluster in South Carolina that has been firmly established and has been around for quite some time. And one of the benefits of traded clusters to a region is that once they anchor to that region, they are highly efficient and very resilient. So we anticipate that manufacturing will come back just as strong as ever. Automotive manufacturing, aerospace manufacturing, tire manufacturing, and all the competitive advantages that South Carolina has previously offered that have helped to create this cluster in South Carolina are still here. And so we are still very bullish on manufacturing for South Carolina in the medium to long run, so 2 to 4 years. So while there are significant short-term disruptions, all of the strengths that South Carolina has offered and the benefits of the traded cluster being here, those are still maintained and will continue into the future.
And what are those automotive clusters you're talking about? We can talk about Volvo briefly. We did see, last time we talked was in January, and it was right before Volvo announced a big $600 million investment in a new electric vehicle battery plant in South Carolina, which they expect to come online in 2022. I'm wondering, you consult on some of these big economic development projects in South Carolina for the state. I'm wondering, when we look at that kind of project, when we look at other expansions or perhaps other economic development projects coming to the state, what does all this economic slowdown mean? Does it just kind of hit pause for some of these companies? Does it just rule out the entire possibility of reinvestment for some companies? How do you weigh that in the current situation?
Well, I think your term, a pause on economic activity, is the most accurate. I think that really sums it up well, because it is a pause. Everybody is waiting to see what happens with the pandemic, with the social distancing that's required. But the Department of Commerce, for example, is continuing to see interest from companies in looking at site selection opportunities, for example. And that's been going on despite the social distancing, despite everything else that's going on right now. So for looking ahead long term, things are still continuing to progress. South Carolina is still at a competitive advantage, and companies see that. So I think we'll continue to see the investments here that we have come to expect because of the resources that South Carolina offers and the competitive strengths that we have. I don't see that really changing. I think it's more of that pause because much of the American economy is on hold. And for larger businesses, they're trying to wait it out. And for small businesses, they're doing the same. But of course, that's the whole point of the stimulus package, is to help the small businesses from going bankrupt en masse before we can get this under control.
Mm-hmm. Enjoy, with just a minute left, just kind of tell me maybe one or two of your concerns, and then maybe something that you're also optimistic about at this point.
Well, I think the biggest concern is what I call the hangover effect, which is the idea that even once social distancing requirements are relaxed or guidelines are relaxed, people are still going to be somewhat hesitant to go back out into public, go to baseball games, or go get a haircut, or do all of their normal activities, because they may still be concerned about getting sick or becoming exposed. So it's important that the health guidelines are put in place in a systematic way such that hangover effect is minimized. And I think that's the other important component in terms of getting back to normal, even once these social distancing requirements are relaxed.
Gotcha. Thank you very much, Jovan Nessen, research economist with USC's Darla Moore School of Business.
Thank you, Gavin. Always good to be with you.
Thanks. I'm joined with Elise Bidwell, who is a financial advisor with Edward Jones here in Columbia. Hey, Elise, thanks for joining us.
Thank you so much for having me, Gavin.
So, Elise, kind of give us a little bit of a market update. Obviously, March was just a roller coaster of a month for the markets. It seems like now that we're in April, things have stabilized a little bit. Not going to say we're not still volatile, but what's it looking like right now, and what are you telling your clients?
Sure, I'll start with a market update. Certainly, March was very volatile. We all lived through that. I cut my teeth in 2008. I started in this business in 2007. And so I just remember how volatile those markets were in 2008 as I was starting out as a financial advisor, and it felt every bit the same in March. So if you think about where we were, where we went, and where we are now, the S&P 500 index in early March was around 2950. It dropped to south of 2200, and we're trading now around 2700 the last time I looked today. So we were down 34%. And are currently down about 16% year to date. So we've definitely seen some whiplash, but we do not think that volatility is over yet.
Mm-hmm. So when you're in the thick of it in March, kind of give me an idea about what your clients were saying to you and what you were advising them. I'm guessing people were really worried and maybe wanted to pull out and then maybe buy the dip. What was it like, and what were you advising people back then?
So a lot of people want to know when the bottom is. And I joke with my clients all the time that if I had a crystal ball and can tell where the bottom is, I would likely be retired. And so would other financial advisors. So it's impossible to time the bottom. So what we do in our office is on our regular reviews with our clients, we are constantly looking and reassessing at what their tolerance for market volatility is. We pair that with their goals for that specific money and their time horizon to determine their mix of investments. And so honestly, Gavin, for the most part, when my clients were calling in March, they were asking what they could do to take advantage of the opportunities that were available at that time. For most of them, their portfolios were set up the way they needed to be set up to weather a storm. We had a few nervous Nellies call in, and certainly there was much to be nervous about. And so what I typically go back to is we've been here before. We know how this ends. We cannot time the bottom, but we know a recovery will come. And there's no reason for us not to be picking up good companies at good values right now that will still be here paying dividends on the other side of this mess.
Mm-hmm. So is it a mix between your younger and older investors, or is it just based on what their portfolio is geared towards, I guess?
Yeah, so that is a really great question. So for the most part, my older investors have been here many times before, and they love individual stocks that pay dividends, even in bad times. It's my investors that are approaching retirement that get most nervous in these times. And so that's why I think it's so important for people to have the right mix of investments dependent upon their risk tolerance and their goals, regardless of their age. Certainly, someone with a high risk tolerance at the age of 90 and someone with a high risk tolerance at the age of 20 should have a much different mix of investments. But some of my older clients have been my go-tos for just staying in the market, buying the dips, and continuing to keep their focus on long term. I'll give you an example of one client that came to me in 2008, and he was in his 80s then, and he's now in his 90s in a nursing home. But I remember him coming to bring me a check in 2008. He's become a wonderful client. We've partnered with he and his family and his wife, and because they're in a nursing home, I can't go see them like I normally would. But because we've worked together and partnered together, making sure that his risk tolerance and his portfolio objective and his mix of investments were right, we've still been able to service them in a great way, even in these unprecedented times.
And when we look at earnings, we're going to see first quarter earnings starting rolling out next week with the banks. I'm wondering, are we going to expect some more volatility there? Are you planning to kind of build that into, again, more buys in terms of dips and things like that?
Absolutely. So I will tell you three things we know about the market. First of all, the market is forward-looking. And so what we saw back in March, we're seeing come to fruition right now in decreased earnings, in some horribly significant jobless claims that we're seeing. In fact, May 8th would be a date that I would tell folks to look at, expect to see, my people are telling me to expect to see the unemployment rate in excess of 10 to 11%, because all of those jobless claims from April will be within that number on May 8th. So certainly there's a lot of uncertainty. The market doesn't like uncertainty either. So when we see the number of deaths that we continue to see due to the virus, none of us are back to normal by any stretch of the imagination. And then the jobless numbers, corporate earnings, all of that could cause a market dip. And the last thing that I will say is that it is not atypical when we have a bear market to see a significant drop, to see a rebound, and then to see us test those lows again. So a lot of your viewers may be hearing on the news channels that we will test lows again likely, and that's what I'm hearing from my economists and market strategists right now too.
Okay, so staying for the long haul there a little bit. With about 3 minutes left, I'm wondering, some people who maybe are in difficult economic situations might be tempted to pull money out of their 401ks. I think the fees are waived. There's some penalties that are being waived. What's your advice for people who are looking at that as a possibility just to stay afloat right now?
Yeah, absolutely, Gavin. There are people that are laid off. 20% of our industry, our industries are laid off, mainly hospitality and restaurant. So there are people that are hurting right now, small business owners. And the CARES Act put some specific things in place, which I won't get into too great of detail right now about. But certainly people under the age of 59 and a half are able to take money out without paying the 10% penalty. And they have 3 years to pay it back from their 401ks and IRAs. The loan provisions for 401ks have been increased from $50,000 to $100,000. What I tell folks is this is not a total last resort. We don't want people to lose their home or build up significant credit card debt in these times with high interest rates. But what we do want people to do is, if they have an emergency bucket of money, go there first. And if they don't, we are working with them to figure out what the best strategy is for taking withdrawals from their IRAs and their 401ks and putting a plan in place to get that money back in the next 3 years so they're not taxed on it.
Mm-hmm. And with less than a minute, Elise, I just want to ask you, as a financial advisor, some Americans will be getting $1,200 checks to some money back. I'm wondering, what do you tell people to do with that money? Maybe do you tell them to jump in the market, look at some of these biotechs or pharma stocks that might be working towards a vaccine? What's your advice to do with money people might be getting back? Or should they just sit on it and keep it in cash?
Sure. No, I think that right now is a good time for a dollar cost average, that we've seen a significant rebound in the market and we think volatility is going to continue. And so just putting a little bit into a good blue chip stock right now. We don't have to be fancy about it. We don't have to look for specific companies that are going to benefit from the coronavirus. Many of those companies are good companies that would make sense to buy into over the next 6 months or so for long-term holdings in their portfolios. But you could just buy into the S&P 500 index. But I'm not buying lump sum right now. That's not my advice. My advice is a little bit each month. And then if we see another big dip, maybe we would go in with what's left.
Mm-hmm. Great advice there, Elise Bidwell with Edward Jones here in Columbia. Thanks for joining us.
Thank you so much, Gavin.
For a look at the most recent issues related to COVID-19 in South Carolina, check out the South Carolina Lead podcast. We've been releasing multiple episodes each week to keep you up to speed on what's happening in South Carolina related to the virus. From South Carolina ETV studios, I'm Gavin Jackson. Be well, South Carolina.